So what difference does this package make to your assessments of Europe's prospects?
The truth is, it's good news, but it makes little impact on our immediate forecast because we always have a 6-month forecast horizon. And the truth is, the fiscal spending will really only start next year and will peak in 23, 24. While for us, what matters is what is going to happen to growth momentum in the near term. So it's going to have very little impact on that. But the good news is there is an endogenous organic recovery process that's already underway. And that should be enough to further lift growth rates in the euro area, further lift the crucial measure of business confidence, which is the PMI, and translate into another 10 to 15% upside for European equities on our projections.
Is this a lift, Sebastian, that you saw happen first in China or Asia, is now happening in Europe, and you expect to happen in the U.S.? I mean, as far as I can see, the virus shutdowns really hit Asia or China first, then Europe very hard, and now are sort of hitting the U.S. in different places. So is that how the recovery is going to work as well?
I think that's a great way of putting it. And in fact, China has been our playbook throughout this period. So we saw how lockdowns lasted around 2 months in China, how when the growth rate in the virus slowed to around 1%, China started to lift restrictions, and how that then translated into a rebound in growth momentum. That has been our playbook, and we followed that playbook. In China, the crucial PMI is already close to a 10-year high. We expect that to happen in the euro area. In China, we have seen a tremendous jump in industrial production, which is now back above the pre-crisis levels. In Europe, it's still 20% below. In the US, it's 10% below. Think about this as recovery potential sitting in the pipeline, waiting to be realized. And that's effectively what we are positioned for.
Sebastian, the underlying recovery story then, picking up there in terms of the PMIs, I know that you see the PMIs as seemingly as important as ever. You're watching the momentum in those PMIs in particular. Based on your notes, we put together a chart that shows the PMI 6-month change and the way that that ties in with US bond yields. Do you think then that we continue to watch this PMI data and it's a useful indicator of where bond yields are going to go and then maybe even where stocks go?
Yeah, I think it's a great summary. Perhaps on the chart, I can see it now on my screen. It doesn't look all that impressive. I would suggest, though, if you take a long time history, 20 years, and you look at the rate of change in the PMI versus the performance of equity markets, the performance of credit, the performance of bond yields, and even individual sectors like banks, farmers, and pharma and utilities, the PMI, if you test it statistically, is simply the best determinant, the best explanatory factor for why these trades move as they do. To give you just one case in point, when the PMI turned in March 2009 and rose by 20 points, that immediately triggered a 30% rally in banks, a 100 basis points increase in US bond yields, and a 50% rally in European equities. We are now just getting into a period, as you can see on your chart, where the rate of change in the PMI goes from deeply negative now into positive territory. On our analysis, it's very likely that the PMI will hit a new all-time high, which means extremely positive momentum in the PMI over the coming months. And as you say, that implies further equity market upside, finally for bond yields to rise, and also outperformance of the cyclical sectors like banks, autos, and capital goods.